So welcome to the technical analysis part of the presentation for today. Give me a sec. My name is Peter Youssef. We're going to be mixing fundamentals with technicals. So in front of your screens, you have the US dollar for chart. All charts to be presented are to be of the same time frame unless otherwise stated. My name is Peter Youssef, Senior Market Analyst at IronFX, and we will be mixing fundamentals with technicals today. We note that the US dollar had a rather sideways motion, practically between the 104.25 and the 103.05. There was a small breakout attempt practically here, but overall throughout the week we were in sideways motion. There are some slight bearish tendencies during today's European session, but nothing significant just yet. I would expect the possibility of an improvement of the market sentiment to weaken the US dollar, maybe cause some safe haven outflows. It was characteristic that Friday ended with US stock markets slightly up, while commodity currencies also tended to gain a bit. So that was an indication that riskier assets were somewhat, or if you prefer, slightly favored by the market. Now we are about to enter a rather heavy week for the US dollar. I would be noting that the past week was rather light. So we may see the rise of the number of high impact financial releases increasing more or less, I wouldn't say uncertain, but definitely volatility. And we make a start on Tuesday with the release of the US CPI rates. And they are for practically May. Now, more or less a possible weakening, or if you prefer, slowdown of inflationary pressures within the US economy could solidify market expectations for the possibility that the Fed's going to remain practically on hold in this coming meeting. On the flip side, though, should the US CPI rates actually accelerate, that may be a surprise for the market, which could provide some support for the USD, while may also at the same time alter the market expectations for the Fed to remain on hold in its June meeting on Wednesday. So it's a big issue. I wouldn't be jumping just right into the Fed's meeting on Wednesday, at least not yet. I would like to see, first of all, what the release of the US CPI rates will show us about inflationary pressures in the US economy tomorrow. For the time being, though, I highlight that the rates are expected to slow down considerably both on a month-on-month and a year-on-year level. And should that be the case, we may see the market's expectations for the bank to remain on hold on Wednesday to solidify. Now, moving to Wednesday, okay, definitely the Fed's interest rate decision is the peak of the week. But I would be also noting the PPI rates just before the release. And should we see another slowdown of the PPI rates on a year-on-year and month-on-month level, as it is being forecasted right now, once again, that would provide some slight bearish tendencies for the US dollar as well. Now, on the Fed's meeting, it's going to be a little bit more complex. Now, let's discuss, first of all, the market expectations. The market expectations are for the bank, A, to remain on hold on Wednesday, hike rates in July, and start cutting rates from November onwards, at least from November onwards. In the interest rate decision, we're going to be getting A, if there's going to be a rate hike or if the bank is going to remain on hold. B, we're going to be getting also the forward guidance of the bank in the accompanying statement. We are going to be getting also the new dot plot, the new economic projections, and half an hour later, Fed Chairman Jerome Powell is going to be delivering a press conference. Should the bank remain on hold and keep interest rate levels unchanged, that would be more or less expected by the market. Currently, if I'm correct, Switzerland's futures imply a probability of around 72% for such a scenario to materialize. So we may see some slight weakening, as only 28% expects a rate hike. The second element would be the forward guidance. For the time being, the market expects the bank to hike rates in July. So most probably, we may see the bank issuing a forward guidance that there's still some tightening to do, but it's nearing its peak. Anything which may sound a little bit more hawkish could be a surprise for the markets and could provide some support for the US dollar. Any further hesitation, which may set into doubt also July's rate hike, or at least July's rate hike expectations, that could weaken the USD. Moving now to the new dot plot, we have mentioned that the market expects the bank to start cutting rates from at least November onwards, if not earlier. Should Fed policymakers actually show in the new dot plot that their intentions are to maintain interest rates at high levels throughout 2023 and actually extend it at least until the first, maybe in the second quarter of 2024, that could rebuff practically market expectations for a rate cut in November, and that could provide a slight bullish reaction for the USD. The fourth element would be the Fed's economic projections. Now, there are increased market worries for the possibility of a recession in the US economy. Should, though, the Fed's projections show that the market expects the US economy to avoid a recession, or even should it expect a recession but be a shallow one, that could provide some support for the USD. And last but not least, let's not forget about Fed Chairman Powell's press conference later on. Fed Chairman Powell has been well known to be able to reverse market sentiment in his press conferences. So we expect volatility to be expanded time-wise. It's not only at the time of the release, but also during Fed Chairman Powell's press conference later on. Should he sound maybe a little bit more hawkish than what the market expects, that could provide some support for the USD. So overall, that would be the idea of the analysis behind the Fed's interest rate decision, at least for the US dollar, for the greenback. But the Fed's interest rate decision is not only expected to affect the US dollar, it may have ripple effects also in US stock markets. Any additional hawkishness could provide some bearish tendencies for US stocks, but it could also overall affect the prices of gold, maybe even oil. Or prices of gold are mostly expected to maintain a negative correlation with the US dollar. So practically whenever you see the USD strengthening, you may expect gold's price to weaken and vice versa. I think that would be the expected scenario. Should we see no negative correlation, that would be a little bit of a surprise from my side. As for oil, any additional hawkishness may imply a slowdown of economic activity, of the expansion of economic activity in the US economy, which in turn, or even a contraction, which in turn could more or less intensify market worries for the demand outlook of the commodity of oil and thus could weigh on its price. Now, besides the Fed's interest rate decision, which is key in my opinion next week, I would also be highlighting a number of other releases, and we make a start with the retail sales growth rate of the US, which are on Thursday. But on Thursday, we also get the initial jobless claims figure and the Fed Business Index. And I would be noting that retail sales on a month-to-month level are expected to drop from 0.4 to minus 0.1%, always month-to-month. That could have a bearish effect on the US dollar, as practically that may intensify somewhat the market worries for the demand side of the US economy. The Fed Business Index is also expected to drop deeper into the negatives from minus 10.3 to minus 10.19. And once again, that could have another bearish effect on the USD, while the initial jobless claims figure is expected to drop from 261K to 250K, could provide some slight support for the USD, as practically the crack in the US employment market's tightness seems to narrow a little bit, and that would be a positive for the US dollar. But we could see practically the other two releases overshadowing the initial jobless claims figure. So more or less, and given that they are all being released at the same time, I would expect some increased volatility here for the USD. And once again, that could have a ripple effect on other markets as well. Moving out Friday, we have the University of Michigan preliminary consumer sentiment indicator. It's expected to rise a bit from 59.2 to 60. Could provide some slight support for the USD. Now, let's see how this all pans out on a technical level. Okay, we have noted the sideways motion between the 104.25 resistance line and the 103.05 support line. Should we see a bearish effect for the US dollar, I would expect the price action of the index to drop below the 103.05 support line and start aiming, if not even reaching the S201.55. I wouldn't be surprised to see it even breaching that level. On the flip side, should the bulls take over, that would be a pleasant surprise for USD traders. We may see practically the USD index rising, breaking above the 104.25 resistance line and reach the 105.45. For the time being, once again, we maintain a bias for a sideways motion between the R1 and the S1. If there's no break of the pre-mentioned levels, we maintain our sideways bias. Okay, let's have a look at Euro USD. Some slight bullish tendencies, interestingly enough. Give me a sec. Let's readjust the chart a little bit. Let's reposition the labels. It's all messed up here. There you go. So, definitely we have to change the R1 as the price action has broken above it. Not only did it break above it, it also has used the support line. So let's change the color to green. And let's go hunting for a new ultimate resistance line. I'm choosing this peak here. It's one of the nearest. It had also support levels here. So that's quite interesting. And that would be in red, please. The 1.10. Yep. Let's widen the chart a little bit. Next one would be set somewhere here. That's clear. One point oh nine ten, 1.0805, one point oh seven 35. That's a bit narrow, but okay. 1.0655. And last one, 1.0535, 1.0545. Positioning it, locking everything in. We're done. So on a technical level, we see that the euro has risen, has stepped up, broken above the 1.0735 resistance line, now to support, even has used it as a support line during today's late Asian early European session. For a bullish outlook, though, I would require the pair to break the 1.0805. Clearly, nothing less. I would require a higher peak than this one. Yes, we have a higher true, but what we're looking here is another high peak. So it has to reach or even breach the R1, clearly. And should the bills maintain control, I would be surprised to see the price action reaching out for the R2 1.09. On the other hand, should the bears take over, as there seems to be an inability to actually break this peak, I wouldn't be surprised to see the price action breaking the 1.0735 and start aiming for the 1.0655. Actually, I would require breaking of the S1 for bearish outlook. Okay. It's interesting though that, give me a sec. I would like to note the upward movement. You can see the touches clearly, 1, 2, shifting it a little bit to the right. That. On the other hand, should the price action break the upward trend line yet remain above the S1 1.0735, in my opinion, that would be a signal for stabilization of the pair. And that would force me to keep a sideways motion bias. For the time being, there seem to be some bullish tendencies, especially during today's European session. They are very notable, but for a clear-cut bullish outlook, I would require a clear break of the R1 1.0805. Some of you guys, actually, boys at, sorry, give me a sec. Yeah, boys at research suggested to lower it to this peak here. It's a maybe, but I still prefer the 1.0805. Now, fundamentally, your traders, okay, there are a number of financial releases which are of interest, but the thing that your traders are turning their attention towards ECB's interest rate decision. That's on Thursday's late European session. The bank is expected widely to hike rates by 25 basis points, both the deposit as well as the refinancing rate. If I'm correct, Euro IS implied probability for such a scenario to materialize of over 90%. So there's as if the market has almost fully priced in the scenario. I would be noting though that the market is also pricing in a possible rate hike in the July meeting as well. So more or less, the bank has to deliver something more than just a mere rate hike of 25 basis points for the euro to get some support. A 25 basis points rate hike has already been priced in widely. So I would be turning my attention, should the rate hike be delivered as expected, I would turn my attention, towards the forward guidance included in the accompanying statement, and possibly ECB President Christine Lagarde's press conference later on. Now, should the accompanying letter show some decisiveness, some hawkishness to curb inflationary pressures within the Eurozone, which, okay, they have slowed down. They have slowed down to 6.1% year on year, if I'm correct, the HICP rate, but they're still triple as high as the bank's target of 2%. So I'm not saying that monetary policy tightening is not working. It is, and that's clear. The question is whether that has been enough or not. I expect Dutch central banker Knot and the French possibly Tagalau, but also or especially German Bundesbank President Nagel to insist for another rate hike in July at least, and keep the September meeting in the balance. So should the bank actually issue a rather hawkish forward guidance, that may reaffirm the market's expectations for another rate hike in the July meeting, and that could provide some support for the euro. Should also ECB President Christine Lagarde maintain a similar tone in the press conference later on, once again, that would be an additional justification of the market's expectations and could provide some support for the euro. Should, on the other hand, though, ECB President Christine Lagarde actually sound a little bit hesitant, that could weaken the euro, and we may see the hike turning into a dovish hike. It's going to be very interesting to see, especially I think Christine Lagarde's press conference. In previous conferences, it was more obvious that okay, the bank is going to be maintaining a hawkish stance and it's going to continue hiking rates. It even practically foreshadowed in prior meeting for the next month. I think we've come to a point where things are in the balance. And it's going to be interesting to see exactly A, how much they are in the balance for the ECB right now, B, how decisive the bank will sound. But other than that, it's not only the it's not only the bank's interest rate decision as such. We have also other releases. By the way, the ECB's interest rate decision is on Thursday. Up until then, I would be noting, give me a sec, from German ZEF indicators. They're on Tuesday, and things are a little bit worse in there. The sense that the current condition indicator is expected to drop deep into the negatives, while the economic sentiment also is expected to drop deep into the negatives. If that's the case, And should they even surpass market expectations and drop even lower, that would imply two things. A, that investors are more pessimistic than what the market expects for the largest economy in the Eurozone, that's Germany, while also the conditions on the ground are deteriorating, and they're deteriorating rather fast. And in my opinion, that's the most worrisome part, given that the Eurozone economy is in a recession, even a technical one. Let's not forget that the UK and the US economies were able to avoid the scenario up until now, but the Europeans were not. And given that there's still some tightening ahead from the ECB, we may see the situation, especially in the manufacturing sector, deteriorating. The manufacturing sector, especially in Germany, is the spearhead of Eurozone's economy. So things, in my opinion, don't look that well. But partially that's understandable in the sense that the Germans especially were relying heavily on Russian natural gas, something which was not so much the case, say, for example, for the UK or the US. So it's understandable that sanctions on Russia or Ukraine have hit the Eurozone harder than the rest and may have an adverse effect, or if you prefer, amplify the adverse effect on Eurozone's economy and may see the Eurozone's economy retreating even deeper into the recession than a mere technical one, as was last quarter's GDP at minus, if I'm correct, 0.1% year on year. Other than that, I would be noting also that we have the industrial production of the Eurozone. That's on Wednesday. Yep. And that's expected to improve. That would be a positive surprise in my opinion. Because practically the industrial sector has gotten the growth of the market, and market was even more focusing around that particular area of the economy. A possible acceleration from minus 1.4% month to month to 0.8% is considerable. Sorry, that's year on year. On a month to month basis, it's even more impressive. It was at minus 4.1%. It's expected to rise to 1. And I think that could provide some support for the euro there. Other than that, let's move to Thursday. Well, we have a number of minor releases from Germany, Italy, France, the Eurozone as a whole. Okay. Whatever there is on Thursday, it's definitely going to be overshadowed by ECB's interest rate decision. So let's move on to the release of Friday, if there is any. Practically, there is the final HICP rate of the Eurozone as a whole, which is expected to reaffirm the slowdown from May, from 7% in April to 6.1% year on year in May. That was the preliminary release. And that could weaken the euro somewhat. That's about it. Once again, for bullish outlook, we would require the pair to break above the R1 1.0805 and start aiming for the R2 1.0910. For a bearish outlook, I would require the pair to drop, break the upward trend line, but also break definitely the S1 1.0735. I would require a lower true than this one and start clearly aiming for the 1.0655. Okay, let's move now to cable. Nice upward movement. Now, cable is expected, as all USD pairs, to be affected by the US releases, but cable has also some pretty interesting financial releases on the GBP side of the pair. Give me a sec, sorry. Okay, we need some readjustments here, definitely. Recalibration required. Okay, first of all, I'm going to be adjusting the S3. Actually, the S3 is out of the picture given that the R1 has been broken. And we're going to be switching it into support line. Note how it has even provided support here on Friday. So we have to go hunting for a new ultimate resistance line. This can be easily deleted. Let's go back. Okay, a resistance line somewhere here is without meaning. I would prefer this peak here. It's very characteristic how the pair tried to reverse downward movement but was not able to hit a resistance and was forced back down, practically forming this clear downward trend line. It was a beautiful downward movement. I'm keeping that a little bit higher just to get the peak of it. And that would be in red. The 1.277, locking everything in, readjusting the chart. Starting with the 1.2395 being set now as the new S3, 1.2465, 1.2535, sometimes presentation is key. You have to be able to have a nice setup chart. It's not just a beautification show, it's a practicality show. It allows you to have a very easygoing, fast glance over the chart and be able to exactly provide you with the details or the necessary information. If, for example, if we have to recognize here, first of all, that there has been an intensification of the upward movement. The upward slope follows the past 48 hours. That's since Thursday. That needs to exactly highlight some bullishness on behalf of the pound. Also note how the RSI indicator is touching the reading of 70, implying a bullish sentiment on behalf of the market for the pair and for the pound, or bearish for the US dollar. So for the time being, we tend to maintain a bullish outlook, and that's being supported by an upward trend line, exactly showing us the limitations of the upward movement. Now, if we accept that the bulls maintain control, then the question is, how high can it get? Well, the first obstacle in cable's course would be, in my opinion, the R1, 1.2610. And that would be within here. The second would be the R2 at 1.2675, showing us by the peak here. And the third one at 1.2770, the peak that we found before. On the other hand, should the bear stick over, the price action should have to break initially the upward trend line, once again showing us A, that the upward movement has been interrupted. But for a bearish outlook, I would require also a breaking of the 1.2535, a lower peak than this one. It has to break this level for a bearish outlook. If it fails to break the S1, then we may see the price action remaining in a sideways motion between the R1 and the S1. Should the best take over, and mind you that the S1 is not to be taken lightly, it has provided support here, but also resistance here, 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 and here. Should the S1 be broken, the next possible target for the bears would be set at 1.2465, a level which provided resistance once, twice, 3 times, and some support here. So that was primarily a resistance level, but given that the price action now is above it, has turned its role into a support line. Even lower, we note the S3, 1.2395. On the fundamental level, there are a number of fundamentals going on for the pound right now. The UK government seems to be facing an electoral challenge. That's interesting. Should that be the case, that may provide some uncertainty on a fundamental political level and thus create some slight bearish tendencies for the pound. But we have also a number of financial releases which are quite interesting. Starting from tomorrow, we get from the UK the employment data, and that to be practically for April. It's the most complete set of data. Albeit we have also some figures, claim and count change for May, which is expected to drop. That's a positive. The unemployment rate, though, for April is expected to tick up from 3.9 to 4%. The employment change figure is expected to drop from 182K to 150K. And the average earnings growth rate is expected to slow down, always including the bonus. Actually, it's expected to accelerate from 5.8 to 6.1. So we're getting a set of mixed data here, because the drop of the employment change and the rise of the unemployment rate tend to create bearish tendencies, but the acceleration of the average earnings index tends to imply that wages, which is a key issue, is most probably going to continue feeding inflationary pressures within the UK economy and may force BOE to actually harden its already hawkish stance. So it's going to be dependent mostly on the figures, rates and figures as such. We may see a mixed reaction should the actual rates and figures meet their forecasts. But to tell you the truth, the unemployment rate ticking up from 3.9 to 4%, okay, it's definitely a crack in the tightness of the UK employment market, but 4% is still pretty low. And the employment change figure dropping from 182K, yeah, to 150K, that's another negative for the tightness of the UK employment market, but 150K, it's quite decent. So we may see any bearish reactions being somewhat subtle here. Should the actual rates and figures meet the focus, I wouldn't expect a heavy market reaction. Let's have a look at the GDP rates, though, which are due out on Wednesday. And things there are a little bit more clear. We're getting the month-to-month rate, which is expected to accelerate, actually get out of the negatives from minus 2.3% month-on-month and reach plus 0.2, which could provide some support for the pound. On the other hand, though, note that the manufacturing output growth rate on a month-on-month basis is expected to decline into the negatives. The same applies also for the industrial production growth rate on a month-to-month basis. So that's not exactly a positive for the pound. Once again, we're getting mixed signals here. Nevertheless, I expect that more or less pound traders may start turning their attention more towards financial releases. On the fundamental side, I would be highlighting definitely BOE Governor Bailey. He will be speaking tomorrow. That's in the American session. And should he sound hawkish enough, that could provide some support for the pound. Okay, let's move now to USDJPY just before we close off. USDJPY has moved below the, let's readjust the chart here. Let's reposition the label so we get a clear picture. Now, on a fundamental level, practically BOJ's interest rate decision on Friday is expected to keep JPY traders on the edge of the seat. No, let's turn this into red, as the price action has moved lower and is already using it as a resistance line. Anyway, there are no major market indications, or at least expectations, that the bank is to maintain. This is a better support line, in my opinion. I'm keeping this one. It's a peak, it's a former resistance line, but it's more obvious than this one, say, for example. And that would be in green. The 136-point ante. Let's readjust everything. Widen a little bit the chart. That's better. Now, we were discussing about BOJ's interest rate decision on Friday. It's an issue. On the one hand, market expectations are that BOJ under Governor Weather may at some point alter its ultra loose monetary policy settings. However, Mr. Weather, as such, has practically declined such an offer. And he expects that the ultra loose monetary policy settings are to remain in place, at least for now. And it was characteristic that he discussed that they are to remain in place until the bank has reached its inflation target. Give me a sec. Let's reaffirm this one. Yep. So I wouldn't expect anything else for the time being. I would expect the bank to maintain a very, very dovish tone, which may weigh on the Japanese currency. There are a number of financial releases, yet the yen has been well known to actually ignore the financial releases as such, unless there's something major going on, say, for example, the CPI rates or the GDP rate, which is not the case this week. But we still note the machinery orders, say, for example, the corporate goods prices, where they're always more of interest. On a technical level, we expect the pair to maintain a sideways motion for now between the R1 and the S1. Albeit, in my opinion, that could be widened. Say, for example, I wouldn't be surprised to see the pair remaining in a sideways motion between the R2 and S1. Note I was able to break above it, but overall maintain the sideways motion over the past week or so. For a bullish outlook, I would require the price action to break the R1, but also break the R2. I would require a higher peak than this one, and the price action to start aiming for the 142.30. On the contrary, for a bearish outlook, I would require the pair to break the S1 138.76, and due to the proximity of the S1 with the S2, I would require the price action to reach as low as the test at least, the S237.70. That should sum it up from all of us here at IronFX. Best wishes for solid trading.
Okay, hi everyone. Welcome to today's webinar. So today we'll be doing Fibonacci series, our first part of 4 on retracements. So we'll give a couple more minutes to let more people join our meeting. I will start perhaps at 6:05. So you can, in the meantime, you can grab a drink, get yourselves comfortable, and then we'll start in a couple of minutes. Maybe in the meantime, I'll do like a sound check. Can everyone hear me? And can you see my screen? Yeah, okay, that's great. Chat is disabled. Okay, let me try and sort that out. Thanks for letting me know. Okay. Okay, maybe you can try the chat again. I've just tried to refresh the chat. Um, it says everyone can type in the chat. Hmm. Okay, let me try and figure that out. But this Q&A works. I can see all of your questions, so that's great. Okay, let me try and figure it out. Okay, can you try now and let me know if it works? Okay, that's great. Okay, that was something with the settings. But yes, I've managed to figure out. Yay. Okay, how's everyone doing today? Yes, Sven, it works now. No problem. Okay. So, where are you guys from? Today is actually my first webinar in a couple of months. So it's good to be back. No, today our is the first session for the Fibonacci series. So it'll just be on retracements. Things like the expansions, extensions, and projections will be in the coming weeks. So today we're just solely focusing on retracements. Wow, Finland and Germany. I bet it's really cold there now. Singapore is hot all year round, so I can't relate. Okay, I'm just checking to see if everyone is here. See if I should wait a little bit longer. Yeah, because people are still joining the call, so just be patient with me. Okay, Sven says it's -3 degrees right now in Germany, and in Singapore it is, I think, 27. So -3 must be so nice. I'm sure the weather is like so nice and relaxing. Whereas in Singapore we're constantly sweating. It's uncomfortable. Oh, remember, you guys can just let me know in the chat throughout the webinar if you have any questions. Oh, we have someone from Mozambique and another from Africa. That's so cool. I forgot how international these webinars are, so it's so nice to speak to people from all different parts of the world. Okay, I think we can begin. Okay, yeah, let's begin. So, hi guys, I'm Melanie. Today is my first webinar, so be patient with me as I get back into the swing of things. But today we'll be going through the first part of our Fibonacci series. It'll be on retracements. So if you have any questions on projections or extensions, expansions, we'll be touching a little bit on that throughout the webinar, but we'll go more in depth in the coming weeks. So as usual, our disclaimer, the information in this webinar should not be considered as investment advice or recommendations, and it's solely educational material only. So take any piece of information from this webinar at your own risk. And IronFX is not responsible for any loss arising from any information contained herein. Okay, so this is me. I'm Melanie. Yeah. Okay, let's just begin. Okay, so here's our agenda for today. Firstly, we'll be going through the essentials of Fibonacci retracement, followed by the ideal market structure. So what you can look out for, significant swings, how important it is to follow market trends. And then we'll be going through the different Fibonacci levels. So we'll also be touching a little bit on expansions as well as Fibonacci extensions. We'll also be talking about the difference between those as well and how to look out for them when you're trading. So after that, we'll be going through how to combine the Fibonacci retracement levels so that you can increase your chances of a profitable trade. And then we will introduce something called the Fibonacci confluence area as well. And then, this is a typo. After that, we'll be going more in depth, talking about the negative Fibonacci levels as well as the levels more than 100%. Okay, so let's begin. So here's a simple checklist to follow when first starting out with Fibonacci retracements and some things to look out for. So firstly, is the market structure clear? So we like to look for really big zigzags. I'll show you what we mean in the coming slides. Secondly, we want to identify recent trends. So is the price going up or down? It's important to always follow the general trend. So you can see in the image that I have included over here at the bottom, um, our starting point is at the top and our ending point is at the bottom. So we can see that there's a very clear downward trend. Okay. Thirdly, you need to identify recent major swing lows and recent major swing highs. So we'll also show you some examples of this in the coming slides. So it's also important to connect the two extreme points, so from highest to lowest or lowest to highest, depending on the general trend. So we'll show you why this is important in the next few slides as well. So over here, we have an example of insignificant swings. So you can see the charts are rather choppy. There isn't really a very clear price movement. And this is what you want to avoid. So this is an example of something that you should not use Fibonacci retracements for. Okay, and this is something that you should look out for, significant swings. So something that has very obvious peaks and troughs. Yeah, over here. And a very clear move up or down. You also want to make sure that you look for a very clear market structure. So Fibonacci retracements should not cut through too large areas of the market structure. You definitely can, but it shouldn't deviate too much from the price movement. So in this case, we can see there is a zigzag structure, and the retracement drawn here cuts through the market structure, which makes it less effective. So when drawing your trend line, you want to make sure that it doesn't deviate too much. Because you can see from here, our starting point is here and our ending point is here, which cuts through a very large area of the price movement. Okay, let me just check. I'm just checking the chats to see if we have any questions. Okay, someone asked what time frame should be used. I'll get into that in a second, but mostly we want to use the larger time frames so that there's less noise when you're trading. Okay, so this is an example of something that you want to do. So you want to pick market structures with really clear upward or downward movements. As you can see over here, the starting point is at point 1, ending point at point 2. So you can see a very clear downward general trend. Even though it does cut a little bit over here, but that's fine because it doesn't deviate too much from the price movement. Okay. So answering your question earlier, these tend to work better on higher time frames. So like H1 onwards, H1, H4, and so on and so forth, because there's less noise compared to your M5 or M15. Okay, so this is an example of a clear market structure. So Although Fibonacci retracements definitely can be used for both choppy and trending markets. And what I mean by trending markets is markets that have like a really general trend, like earlier in the earlier slides. But over here you can see there's quite a bit of movement. But the Fibonacci retracements can be used for these as well. But it's important to look for clear market structure. That's the main point. Over here, you can see this is an example of an unclear market structure. Okay. So one thing we can do to find clearer market structures for our Fibonacci analysis is to adjust the time frames so that the market structure is clearer. So what might look messy on an M30 chart might look very clear on an H4 chart. So I'll show you the next slide. So if there's too much chaos in the shorter time frames, it doesn't mean that the entire currency pair is not able to be analyzed at that point of time. It could just mean that you need to take a step back to get a clearer view. So I'll show you what I mean in this upcoming slide over here. So this is an example of a chart on an M15 view. So you can see there isn't really a very clear trend, no clear market movement as well. But if we zoom out and we look at the 1 hour time frame, it's quite clear, especially in this highlighted area. So we have much clearer movement, and it's less messy compared to the M15 one. Okay, any questions so far? No? Okay, let's move on. Okay, so from the past few slides, this first section, it's important to note that the clearer the swing low or swing high, the clearer the trend between the 2 points, the more accurate your Fibonacci retracement will be. So that should be the main takeaway from the first few slides. Okay, so now that we know how to draw Fibonacci retracement trend lines and we know what to look out for, let's look at the different types of levels ranging from negative all the way to more than 100. So in the negatives, we have minus 61.8 and minus 27.2, which are classified under Fibonacci expansions. And all of these in the middle are your Fibonacci retracements. And then above 100 will be Fibonacci extensions. So like I said earlier, we'll go in more in depth in the coming webinars, but we'll just briefly introduce them and how to go about using them as well. Okay, so over here, it just shows you an example of all of the levels that I've mentioned earlier. So for here, the starting point is at this level. Oop. Ending point is over here. Okay, so here's an example of the Fibonacci expansion and how it plays out. So our starting point is here, ending point is here. So for expansion, you want to look for a flash zigzag, which you can see over here from the arrows. It's like a flash kind of symbol or a lightning bolt. So you want to look out for these when you identify Fibonacci expansions. So you retrace the mid-range from here to here. And you make use of the support in the negatives, which means like the negative 27.2 and the negative 61.8. So we expect price to retrace back up to this 61.8% level because price has tested this level earlier, as you can see over here. So it tested this level and then it reversed off. So we expect it to come back down to this negative 27.2 or even negative 61.8. So I'll show you in the next slide how it actually plays out. So here we see the price really reacted off of our minus 27.2%, and then it came back up to our ending point. So typically price, not always, but typically price will come back to the ending point after bouncing off a negative Fibonacci retracement. Sorry, a Fibonacci expansion level. Okay, so let's move on to Fibonacci extensions. So those beyond 100%. So when using the 127 and 161.8 levels for extensions, we want to look out for the V shape or Nike tick as shown here. So in this GIF, you can see how price bounces off of these levels. Let me just start it all over again. Okay, here. So this is our starting point. The shorter end of the tick is your starting point and ending point. And then price will continue to rise from these levels. And after it's reached this level, it reverses off it. We can see over here that it tested the level once again, but it ultimately bounced off it to reverse and drop back down. Okay, let's move on to the next slide. Okay, so when does a Fibonacci retracement become invalid? So one of the most common scenarios of this is when price makes a lower low. So assuming you are drawing a Fibonacci retracement from the top to the bottom, if there are bars on the right that break your ending point, it becomes invalid. So there are Fibonacci retracements that are negative, so like the negative 27 and negative 61.8. And we'll touch on these as they go basically beyond the endpoint, and yet they are still valid. So I'll show you what I mean over here. So this example of an invalid retracement. So the ending point, which is here, you can see that price actually reversed off the ending point, but it made a lower low. So this Fibonacci retracement over here, the trend line, is now invalid. Sorry. So similarly, if it's going higher, if it breaks the ending point and it goes even higher, then it's invalid as well. Any questions so far? No questions? Okay, let's move on. Okay, repeat the last bit. Okay, so how you identify once your Fibonacci retracement is invalid is when, so you can see over here, price is moving downwards. In this case, it's a downtrend. So when it's moving down, do you use this lower low as a new ending point? Yes, correct. Yeah. So you can see it's moving downwards. This is originally our ending point. But since price reversed off this level and went even lower, so this should be our new ending point. So even though I said earlier that you shouldn't cut through the price movement too much, in this case, it's not a large area, so you can still you can still cut through this area because the general trend is still downwards. So this should be your new ending point. I hope that's clear. Okay. Any other questions? See the previous slide. Sure. No worries. So the main key point is that once it breaks your ending point, it becomes invalid. Okay? Okay, let's move on. So now let's take a look at Fibonacci extensions. So here you can see a very obvious Nike tick. The starting point is here, ending point is here. For Nike tick, you want to take the shorter end of the tick, the starting point. So you retrace this area, this trend line is over here. And it results in a reversal over here. When you use this trend line, it gave us a 161.8 projected level. So we are expecting it to rise to this level and reverse off of it. Oop. So 127 would be perhaps in between here. So you might want to wait for price to break through the 127 level before going in for this trade at 161.8. Okay. Okay, let's move on. So we've gone through earlier the key Fibonacci levels that work, the expansions, extensions, as well as the retracements. So there's always a huge debate on whether some levels work better than others, but the truth is that Fibonacci retracement levels work sometimes, but they work all the time. So that's the problem. So how do we minimize this issue and increase our chances of being profitable? So what we've come up with um, that works by combining Fibonacci retracements. How do you expect that it will go to 161 and not 127? Okay, so so as I mentioned earlier, 127 would be perhaps around this area. So you might want to wait for price to break through the 127 level before going in for the trade for 161. Because at the 127 level, it could reverse or break through. So you want to wait for it to break through before going in for the trade at 161. Does that make sense? Okay. Okay, no worries because let me just try and explain it again. Because the 127 level is obviously below the 161 and above the 100. It's in between. Should be in between this area here. So if price hasn't reached the 127 level yet, it's not advisable to go in for the trade at 161 because it hasn't broken the level yet. So it could reverse off of the level or it could go up. So in this case, we know that it went up. So after it breaks through the 127 level, then we can go in for the trade at 161 projected level. Okay, I hope that helps to like clear things up. Okay, so let's talk a bit about combining the Fibonacci retracements. So the trick is to find multiple Fibonacci retracement levels that line up together so that you can increase the probability of a bunch of Fibonacci retracement levels working instead of a single Fibonacci level working. So this is the definition of Fibonacci confluence. So we'll show you an example of what we mean and how this can play out in the next few slides. So, okay, maybe I'll start with this photo first. So over here, we have a negative 27% Fibonacci retracement. So you can see this is the starting point and the ending point is here. Okay. So then we have a 161.8 Fibonacci retracement. So that would be starting point here, ending point here. And then we have a 78.6% Fibonacci This should be Fibonacci retracement, sorry. The 78.6. So that all lines up nicely and we expect price to bounce off of this confluence area since all three of our Fibonacci levels line up together. And you can see that price really bounced off this area and it resulted in an uptrend after that. Okay, I have a couple more examples, so if you're a little bit confused, don't worry about it. But if you have any questions, you can pop it in the chat as well. All good. Okay. So here's our first example. So we have a Fibonacci retracement starting from here and ending here. And this gives us a 50% Fibonacci retracement. And the level is in yellow, this level over here. So that's the first one. Secondly, we have a Fibonacci retracement starting from here and ending here. And this gives us this green area over here. And then it lines up nicely with the 50% Fibonacci retracement. Okay. So lastly, we have a 127.2% Fibonacci expansion starting here and ending here. So ultimately, we have three Fibonacci retracement levels all lining up, and it gives us a very strong Fibonacci confluence area. So what we expect is that what we're going for is to play a bounce from a strong area of Fibonacci confluence support, which is basically all the colors lining up this area. Okay, so we'll show you the result of this. So as you can see in this picture, price went down to touch this strong area of Fibonacci confluence support and it bounced up nicely. Okay, any questions so far? Yeah, so you're combining one big Fibonacci retracement level with two other smaller Fibonacci retracement levels. So you can see this is the really big one, and then you combine it with the two smaller ones over here, the green and the red. So you just pull out your Fibonacci retracement levels, and then you can just connect from the starting point to the ending point of each. And then you see where the levels line up, and that should give you a strong area of confluence. Okay, hope that clears things up. Okay, let's move on. So here we have another example. So in this example, we combine one Fibonacci retracement with two Fibonacci extensions. Okay, so the very first one, let's start with the yellow one. Starting point here, this is our middle point, and our ending point is here. So this is the Nike tick that we mentioned earlier, the Fibonacci extension. Okay, and it gives you an 88% Fibonacci extension, which lines up with the 61.8% Fibonacci retracement. Starting point here and ending point here. You can see a very clear downtrend here, the green arrow. Okay. So for the last Fibonacci extension, we have another flash over here, the red arrows. So remember, for Fibonacci extensions, we're looking for the flash symbol or lightning bolt symbol, however you want to call it. So for yellow, it's like this. For red, like this. So for red, it gives us a 61.8% Fibonacci extension. So we can see that all these three levels line up, and it gives us a strong area of Fibonacci confluence to trade from. So what I would do is wait for price to make a push up to this area, because currently price is at this red line here. So I wait for price to make a push up to this area, and when it touches this area, then I would short the market and play the drop. Okay, so this is what I mean. By waiting for it to go up to this area and wait for the reversal before you short. Any questions about this second example? Okay, so let me just go back to the previous slide. Yeah, so here you can see there's three different Fibonacci, two different Fibonacci extensions, as well as one Fibonacci retracement. So the Fibonacci retracement is the one in green. Fibonacci extension is the yellow and the red. And how you know this is because of the flash symbol. So like, it's like a lightning bolt. Yeah. Okay. I'm just reading some of the chats or the questions. Okay. Okay, I'll move on. So for the third example, we're bringing in support and resistance levels. And this leads to really high probability setups. So here is an example of how we combine pullback resistance and two Fibonacci retracements as well as a Fibonacci extension. Okay, so I'll show you where each of them are. The red level over here is the pullback resistance. Because price tested this area, it bounced off of it and it crossed this area over here. So this is a pullback resistance. The Fibonacci retracement is the yellow line, starting point here and ending point here. This gives us 61.8% Fibonacci retracement, which lines up with Fibonacci extension, which is over here. We can see the flash sign again in the green arrows. Can you guys hear me? Someone said they can't hear me. I think the audio is fine. Okay, let me just reply. Sorry. Okay. Where was I? Okay, yes. So you can see the flash over here, the flash signal. This is a Fibonacci extension, the green arrows. And then we have another Fibonacci retracement, which is the red arrow. Okay. And all of these three levels line up with our pullback resistance. So it's a very strong Fibonacci confluence. And it's also a high probability reversal zone that has the potential to see price reverse strongly from this area. So in such situations, you could place a short entry over here at this area. Okay, let's see how this played out. So you can see price reversed off of this area. And it reversed right as it hit the confluence area. So because this area is so strong, and you can tell based off of the Fibonacci retracements lining up as well as the pullback resistance or any support and resistance levels that line up with the Fibonacci retracements should give you a very high probability reversal zone. Okay. Are there any questions about any of the three examples that we've gone through so far? Yeah, I'll give you guys some time to digest what I've just gone through from the three examples. Sorry, catching a cold because it's been so rainy in Singapore. Okay, so the main point from all of the three examples is basically to stack a bunch of Fibonacci retracement levels or support and resistance levels to try and get the most high probability confluence area that you can get. And then see whether it has a high potential for price to reverse off of it. Okay, let's move on. So here's some trade management tips with the Fibonacci confluence. So for stop loss, it should always be beyond the key Fibonacci confluence area. So the reason for this is because more often than not, price is attracted to such strong areas of Fibonacci confluence. And if your stop loss is right before instead of beyond it, you'll most likely get stopped out right before the market reverses. And this is one of the reasons most people wonder why they get stopped out right when the market starts to reverse, and then they complain about it. So, but not you, because now you know. So you can see over here, your stop loss is below it or beyond this Fibonacci confluence area. So there's some buffer over here. So just in case the market doesn't go um, exactly how you expect it to when you buy, so your stop loss is there's some leeway. Okay, so let's move on to the take profit. So your take profit should always be before your Fibonacci confluence. I see the slides are slightly incorrect, but for take profit, it should always be your before key Fibonacci confluence area. And the reason for this is because when price reaches the confluence area, there's a high chance that it will not be able to go beyond it. So you can just ignore the slide here, but take a look at the image below. So our take profit is before the big confluence area. Why? Because there's a high chance that it will not be able to go beyond this area. So instead of reaching your profit target, it might reverse back to your entry, or even worse, your stop loss. So this is one of the reasons why people may complain that the market is being manipulated, because they miss their TP, their take profit, by 1 pip. So you should always put it before the major Fibonacci confluence. As you can see, there's also some leeway over here. So um, there should always be a little bit of buffer between the Fibonacci confluence as well as the take profit and stop loss. More of like a just in case measure. Are there any questions? Okay, I think there are no other questions. So that brings us to the end of our webinar. Okay, so before you guys go, let me just pull it up. So IronFX actually has a VIP trading room. Not sure if you guys know, but I'm just gonna let you guys know right now. So depending on your deposit, you can access the different premiums. This is on the ironfx.com website. So you can just take a look over here and you get VIP room access. And what I mean by that is over here, this brings you to our page. So let's say, for example, today we went through Fibonacci retracements. So you've been through our webinar, but it won't really help unless you have the space to practice. So the VIP room gives you um, the space to practice however you want. Let me just remove everything. So we have Fibonacci retracements, extensions, um, any horizontal rays that you guys want. So for example, if I see that this is a resistance and I'm not sure if my analysis is correct, you can go ahead and type a message in the chat box. So like maybe Desmond, hey, you can see that there are a lot of people in this chat. So if you put it in, there are many people who will be willing to help you, as well as some of our um, pro analysts as well. I am also in this chat, so you can go ahead and type it in. I don't know why it's not showing up. Okay, but you can tag whoever you want. Hey Desmond, is this resistance valid? And then you can highlight the resistance, link object to text, and then click on this. And then you can just send it in. So we try to reply as soon as possible. I think within 24 hours, you should get an answer. Yeah, so if it works for Fibonacci as well, if you want to check your retracement, like, is this valid? You can go ahead and tag that as well. Link object to text, and then you can choose which level you want. So maybe like 50%, and then it'll choose it for you. So confirm, and then when I go over it, it will highlight it. So whoever is reading your chat will know what exactly you are referring to, and they'll be able to help you better. Same for the Fibonacci as well. 50%, so you can see the 50% is being highlighted. Okay. Okay. If there are any other questions, you guys can drop them in the chat. But if not, yep. Thank you guys so much for coming today. Um, Let me just open the chat. Okay. Yeah, thank you guys so much for coming today. Have a great rest of your week. Um, and I'll see you guys next week. Yeah, I think there is a way to see the recording. I don't think you can download the presentation slides, but the recording for this webinar, yeah, it's being recorded. Let me just see where you can find it. I think you can check the IronFX page, the website. Okay. Any other questions? No? Okay, thank you guys so much. I'll see you guys next week. Yeah, this may be a little bit difficult to understand, but no worries, you can go back and watch my presentation again. um, and practice it on your own in the VIP trading rooms, and we'll definitely help you out over there. I think it would help you understand better if you actually played around with the Fibonacci retracement levels. Yep, thank you guys. Bye.
Everyone, in today's video we're going to look at expert advisors. Expert advisors are computer programs that run on the MT4 trading platform. By using algorithms, EAs are able to monitor and trade financial markets. Basically, EAs are used to automate trading and find opportunities. You can program the software to initiate and execute trades for you by using the parameters you set. For example, you can use an EA to monitor a few key markets. The expert advisor will alert you when it finds a potential opportunity, and you can program it to carry out trades for you and open multiple positions every day. However, there are some benefits and disadvantages that you should be aware of. As trading is automated, an expert advisor removes the emotional factor from your trading. This means that your fear of loss or greed for more profit will not affect your trades. EAs can reduce stress levels because it takes away the anxiety of trading. Therefore, you can set your trades for the day and do other tasks instead. An EA can run on any market that you can trade with MT4, taking lots of information into consideration, such as price movements and news announcements. Our brains are not fast enough to match the speed of an EA. One disadvantage of expert advisor is they cannot respond to real-time news. They basically ignore factors that cannot be programmed into them. If you are at your computer monitoring the news, you can avoid making a trading mistake after a news release, but the EA will keep trading if it's set to do so. Even though the EA can deal with more variables at once that humans can, it can only act in the way it has been programmed to. There may also be times when you need to interrupt the EA to avoid a big trading error or take an opportunity. Whether you use a third-party EA or create your own, it's important to backtest it over various timeframes in a demo account before using it on live markets. A demo account does not risk real money and lets you see how the expert advisor performs for you. You may find that it works well for you on some currency pairs, but not on other pairs. Simply do your research before committing to using an expert advisor. There are good EAs out there, and some traders achieve year-over-year gains using an EA that trades automatically. Thank you for watching.